Welcome you all to this session on accounting for partnerships. Today, throughout this session, we'll be discussing how we can account for partnerships. We'll start with understanding the concept of a partnership. What is a partnership? As we all know, partnership is a business which is conducted by two or more people, and the purpose of conducting this business is to earn profits. So accordingly, in order for a business to be a partnership, there has to be several elements. What are they? There must be two or more people. According to the Companies Act, a partnership will include a maximum number of 20 people. Then there must be an agreement between the people to carry out the business. So it can be an oral agreement or it can be a written agreement. Then this business is operating to earn profits, not for any other purpose, to earn profits. So if all these criteria are met, then we call this particular business a partnership. Then, what is the difference between a partnership and a company, a limited liability company? The main difference is a partnership does not have a separate legal personality, which means the partnership itself is not considered as a legal person. Therefore, for the liabilities of the business, for example, let's say there is an amount paid to an external creditor. For the external liabilities of the business, all the partners are individually and jointly liable, because the partner's liability is unlimited. Right, now we'll see how a partnership is formed. A partnership can be formed by mutual agreement, or mutual agreement means it can be an oral agreement or it can be implied. That means it's not expressly told that this is a partnership, but it is implied that there is a partnership business. Or else, the most common way of forming a partnership is having a written agreement. So this particular agreement will clearly mention the rules, the things that the partners have to consider in conducting and managing the business. Next, we will quickly go through what is the legal framework that is affecting to a partnership business. Mainly the Partnership Ordinance of 1890. We don't have a separate Sri Lankan Partnership Act. Therefore, this is the Partnership Ordinance that we are using. Prevention of Frauds, Ordinance of 1844. So this will say if the initial capital of the partnership is over 1,000 rupees, then there should be a written agreement and it has to be signed by all the partners. This is in order to prevent the frauds. Right. Next, legal act or the legal background comes from the Companies Act of number 7 of 2007. So this is the one which is stipulating the maximum number of members that a partnership business can have. So that is 20. But this can differ for professional firms, stock brokerage firms, and legal firms. Another one is Business Names Ordinance of 1918. This says if a partnership business is operated in a name other than those of its partners, then that partnership is compulsory for registration. Right? Other than these four main acts and ordinances, there are several enactments, and those will include Consumer Protection Act, Price Control Act, Shop and Office Employees Act. Before we move into accounting side, we'll see what are the advantages and disadvantages of having a partnership business. Now we know for a partnership business, there has to have partners between 2 to 20. The other type of business which is not having a legal personality is the sole proprietorship. So when we compare partnership businesses with sole proprietorship business, what are the advantages? More capital can be ascertained because there are more people. So more capital can be raised. And then since the partners, there are number of partners or number of owners, then different people can contribute in different ways. They might be having diversity of knowledge, experience, and expertise in different areas. So they can make use of this knowledge, experience, and expertise. And also, the risk can be shared among the partners. If it is a sole proprietorship, the total risk is lying in the hands of the owner or the proprietor. But if it is a partnership, that will be distributed among the partners. So what are the disadvantages? Not like a sole proprietorship, in a partnership business, the partners cannot make decisions as they wish. Why? Because there are so many owners. So they can't act independently as in another business, as in sole proprietorships. Then the number of partners are limited to 20. Again, if it is more than 20, more capital can be raised. Therefore, it can be considered as a disadvantage because the number of partners are limited to 20. And the partnership is not a legal entity. So what is the impact of it? If it is not a legal entity, there's no legal personality. And therefore, sometimes the going concern is also can be a doubt, because if the partners have to, if any partner is going bankrupt, then the whole business have to be terminated, shut down. Therefore, the going concern is a doubt as a result of not having a legal personality. Other than these advantages and disadvantages which I mentioned here, there can be other advantages and disadvantages as well. So you can decide whatever it is, and you can give more and more advantages and disadvantages for having these partnerships. Right, now we discussed in order to be a partnership business, there should be a partnership agreement. So what is this partnership agreement? That is, it's an agreement between the partners, but is it compulsory to have in writing? No, it is not compulsory. That is why we said in forming partnerships, there are three methods. It can be a written agreement, It can be an oral agreement or it can be implied as well. Therefore, it is not necessary or it is not compulsory to have this agreement in writing. However, it says if this partnership agreement is in writing, it will reduce the possibility of disputes, because this partnership agreement will clearly mention all the rights and responsibilities of the partners. Therefore, the possibility of having disputes between the partners will be minimized. Right. Now, according to the acts, if the partnership exceeds the initial capital of ₹1,000, there should be an agreement in writing. And it has to be signed by all the partners. So what are the things that are included in a partnership agreement? Now we know this partnership agreement is the agreement between the partners. Therefore, obviously, the partnership agreement should include the name of the partnership. What is the partnership's name? Names and addresses of partners. Who are the owners of this business? Nature of the business. What type of a business they are conducting? The principal place of the business. Duration of the partnership. If there is a particular duration for this partnership, what is it? That means, let's say, they are forming a partnership only for a period of 5 years. So that has to be mentioned in the partnership agreement. The amount of capital to be contributed by each partner. The method of sharing profits and losses. This is very much important. This is the profit sharing ratio. Depending on the profit sharing ratio, most of the decisions are taken. The rights and duties of partners. These spellings are not correct. Rights and duties of partners. So there can be working partners. There can be nominal partners. So what are the rights and duties of them? The authority of each partner in contractual situations. So there can be some partners who have the power or who has the authority to sign for something. So what are they? The additional capital contribution by partners. If any partners are contributing in addition to the capital they employed, what are the consequences? How they are being paid? What is the additional interest that is paid on capital? Whether interest on capital or on drawings or both is allowed or changed, and if so, at what rate? That means if the interest on capital is given, if the drawings, interest on drawings are charged, if they are charged and if they are paid, what are the rates? Whether current accounts are to bear interest, and if so, at what rate? If there's any interest that is being paid on current account balances, what is the rate? Whether partners are to be allowed remuneration for their services, and if so, the amounts. The procedures to be followed in the event of disputes. This is why there should be a written agreement. So if there is a dispute among the partners, how this is handled? The assessment of goodwill. How the operations are to be conducted and how the various partners' interests are to be satisfied upon the admission, death, retirement, and the cessation of business. So we will be talking about these things, not in detail, but we'll go through all these areas. Right. Now, let's say if any partnership business is silent on any matters that we discussed in the previous slide, then what happens? Then the Partnership Ordinance of 1890 comes into play. Section 24 of the Partnership Ordinance of 1890 provides some rules as to what are the ordinary rights and duties of partners. So if they do not have any agreement, or else if the partnership agreement is silent on certain matters which we discussed earlier, these rights and duties of partners will apply. What are they? The rules will include the following factors. What are they? All the partners are entitled to share equally in the capital, profits and losses sustained by the partnership. That means the profits will be shared among the partners equally. At the same time, they will contribute to the capital equally. The partnership must indemnify every partner in respect of payment made and personal liabilities incurred by him. That means, now let's say, if a partner is paying an advertisement expense on behalf of the partnership, and then he has the right to reimburse it. But there are several conditions. 2 conditions actually. What are they? This expenses has to be in the ordinary and proper conduct of the business of the partnership. For example, now I said it's an advertisement expense. So if it is advertising, that is relevant for the business. Therefore, it can be claimed. You know about anything necessarily done for the preservation of the business or property of the business. Now, let's say there's a court case going on against a property of the business, and one of the partners are paying the legal fees. So this is something necessarily done for the preservation of business property. So they can be reimbursed. A partner making any payment or advance for the partnership beyond the amount of the capital, then he is entitled to interest of 5% per annum. That means, now other than the capital that they need to invest for the business, if they are making any additional capital to the business, then they are entitled to receive an interest of 5% for that additional amount. A partner is not entitled to interest on the capital subscribed by him. That is additional capital. The previous one we discussed is additional capital. Here we discuss about the capital. There's no interest on capital according to the ordinance. So, even though the ordinance stipulates that there is no interest on capital, the partnership agreement, the partners can include a sentence saying that the partners are allowed to interest on capital amounting to this percentage. That can happen. But if that area is silent in the agreement, this is the rule that is going to apply. Every partner must take part in the management of the partnership business. No person may be introduced as a partner without the consent of all the existing partners. So let's say there's a ongoing business, and if any new member is coming in, the consent of all the partners should be taken for that. Any matters connected with the partnership may be decided by the majority of the partners. And no any change may be made in the nature of the partnership without having consent of all existing partners. Mainly, the purpose of having these rules and regulations are to prevent the issues, or to prevent the problems between the partners. Right. The partnership books are to be kept at the place of business of the partnership, and every partner may have access to inspect and copy any of them. So the books of accounts have to be kept in the partnership business. Where the business is conducted, there has to be the books of accounts, and all the partners have the access to the books of accounts, and they should be able to inspect and copy them. Now we'll move on to the main topic of our session, that is accounting for partnerships. Great. In addition to the normal accounts that we prepare for let's say for a sole proprietorship, there are certain accounts which are additionally coming for partnership businesses. Those will include partners capital account, partners current account, partners loan account, and profit and loss appropriation account. So we will then go through each account and try to understand what these are. Partners capital account. What is this? This is the account that records the fixed interest or the fixed ownership of the partners. As you all know, we prepare this in several columns. The debit side and the credit side. In each side, there are several columns for each and every partner. So the balance will be recorded at the credit side because it is capital. Therefore, the balance will be recorded at the credit side of the account. So there are certain adjustments that are done to this partner's capital account. If the partners are making any additional capital, that will be again credited to the capital account. And if there are any goodwill adjustments, that can be the credited or debited. And for the revaluation also, that is coming to the capital account. Now, what is the double entry if it is a normal business and revaluation is done? Whatever capital reserve account is credited and debited to the particular asset. So here also asset is debited and credited to, not to the reserve account, to the partner's capital account. Right. So you can see the transactions that are coming to partner's capital account. Next one is partner's current account. So this is like what is actually due to the partner. This will show, this is again, it has debit side and credit side, and each side we have separate columns for the partners. So in this example, there are only two partners, A and B. So for A and B, there are two columns in each side. In this partner's current account, we record the current changes in the partner's interest to the business. What are the current changes? There can be an opening balance, it can be debit or credit. Then there can be certain transactions. If the partners have withdrawn some money as drawings, it can be money or goods, then it is coming to the current account. It is debited to the current account. Why? The interest to the business is reduced by that amount. And interest charged on drawings, similarly, like the drawings, that will be debited because the interest to the partnership is reduced. Interest on capital, that is increasing the interest of the business. Therefore, it is recorded to the right side or credited to the current account. Partner's salary also the same, and partner's share of profit. That is again credited to partner's current account. Third one is partner's loan account. Partner's loan account, there are two instances where this partner's loan account is created. First one is if a partner is bringing additional money into the business as a loan. That is one instance where a partner's loan account is created. And the other one is for the retiring partners. Now let's say if a partner is retired, then his interest is calculated separately and transferred into a partner's loan account. For partner's loan account, interest of 5% will be given. The last one, under the 4 accounts that we discussed, that is profit and loss appropriation account. Profit and loss appropriation account means once we calculate the profit of the partnership business, and then it has to be distributed among the partners. It will be distributed among the partners by way of salaries to the partners, interest on capital contributed, and share of profits. At the same time, there are certain deductions from partners' income. Those are the interest on drawings. So likewise, the account which is prepared to record these transactions are called profit and loss appropriation account. Now, the most important thing is it says, however, it is important to note that any income received from the partnership business within the capacity of a partner should be recorded in the profit and loss appropriation account. So if any transaction has been occurred in the capacity of a partner, then they will be recorded in the P&L appropriation account. If not, that will be recorded in the P&L account. Now, when we do a sum, we'll understand what are the income and expenses received and paid within the capacity of a partner and within the capacity of a under the normal course of business. Right. This is an example for profit and loss appropriation account. Profit brought forward means the accounting profit that we calculated. Then interest on drawings. If there are any interest on drawings, that has to be charged from the partners. Therefore, it will be debited to the current account and credited to P&L appropriation account. On the other hand, salaries to partners, interest on capital, profits for the year, those are income or amounts that are being paid to the partners. Therefore, these will be credited to the current account and debited to the profit and loss appropriation account. Right. Finally, you will get the answer. Now, the final answer will be the amount that is distributed among the partners, which is recorded in the current account. Here I have given some of the accounting entries. Accounting entries for drawings. Drawings means the amounts that the partners are withdrawing from the business. It can be either cash or goods. If it is cash, cash will be deducted, so cash is credited. Debited to partner's current account. If it is goods, same as the previous one, partner's current account is anyway debited. Credited to purchase or trading account. If it is cash, it goes to cash account. If it is goods, it goes to purchase or trading account. So in preparing the P&L account, if there are any goods drawings, that will be deducted from purchases. Now this is drawings, the gross amount of drawings. Next one is interest on drawings. Interest on drawings, again, current account is debited. Why? the interest for the business is reduced from this amount. Therefore, the current account is debited and credited to P&L appropriation account. P&L appropriation account means it's the same as the P&L. How the accounting profit that we calculated up to now, apart from the transactions that are taken place between the partners, how that is distributed among the partners. Therefore, this interest on drawings means it's like a receipt to the business. The income of the business will be increased by this amount. Therefore, appropriation account is credited. Right, accounting for partners' salaries. Salaries, it's a interest which is received by the partner. Therefore, current account is credited. Then it's an expense to the business. Therefore, debited to P&L appropriation account. If it is paid in, salaries are withdrawn by cash. Anyway, if there is a salary that is to be paid to the partners, the first double entry will be passed. But if the salaries are withdrawn by cash, then current account is debited because already we have credited to the partner's current account. Now we remove that amount. So he is no more entitled to receive it. That is debited and cash account is credited. Likewise, interest on capital also, current account is credited and P&L appropriation account is debited because that is a expense that is going to the partners. If it is taken by cash, cash account is credited and it is not entitled to have it in the current account. Therefore, current account is debited. So these are the basic double entries that we have to follow. Right. Next, we will move on to a separate topic, that is recording of unrecorded assets. What are unrecorded assets? As the word implies, unrecorded assets means the assets which are not being recorded. These belong to the firm, but they are not recorded in the books of accounts. Why? Maybe it's written off. Or maybe in order to build this, no costs were incurred and therefore it cannot be reflected in the books of accounts. So if there are any unrecorded assets, what happens? Now, if it is a sole proprietor, there's only one owner for the business. Therefore, even though the assets are recorded or not, he knows at the end, he is the one who is getting all these things. But if it is a partnership, it's not like that. The partners need to get the assurance that they are getting the benefit of these unrecorded assets. For example, now there are given some examples, unrecorded assets, goodwill. To the extent it is not in the books, maybe there's a goodwill, but that is not recorded in the books of accounts. Unrecorded appreciation in the value of fixed assets. There is an appreciation of fixed assets, but that is not being recorded in the books of accounts because we say, for example, let's say a fleet of vehicles which are revalued. The revaluation policy is to revalue the vehicles in each and every 3 years' time. So in the second year, it is not being revalued. Therefore, there's an unrecorded asset, unrecorded appreciation in the value of fixed assets. And life insurance policy where the annual premium paid have been written off. So these are some examples of unrecorded assets. If these unrecorded assets exist, that will create issues between the partners. Therefore, the partners need to get the assurance that the partners will receive this benefit in the profit sharing ratio. Right. Having said that, let's say the profit sharing ratio is going to change. Maybe the partners are deciding to change the profit sharing ratio. Maybe a new partner is admitting to the business. Then what happens? The profit sharing ratio is going to change. For the unrecorded assets, the new coming partner is also getting the part of that benefit. Is it fair? No, it's not fair. Because part of the benefit is paid to the new coming partner, which is not fair. An example is given. Read it. We'll read the example. A partnership where P and Q are equal partners and R is about to join for a third share of profit. Assume goodwill is worth 300,000 but is not recorded in the books. If it is recorded now, P and Q would receive a half share of the profit arising therefrom. Whereas if it is recorded after the arrival of R, who would also then stake his claim for all profits recorded after his arrival, P and Q would only receive 1/3 of the profit. Thus, leaving goodwill unrecorded in the event of a new partner being admitted would cause unfairness arising thereby to each of the original partners. To avoid such unfairness, either the goodwill should be recorded before R's arrival, or the extent of the unfairness arising thereby to each of the original partners must be measured and adequately compensated. Simply, what it means is, now previously there are two partners, P and Q. Another new partner is coming. Then there are three partners, P, Q, and R. There is an unrecorded goodwill amount, 300,000. This is not recorded in the books. So if they record it now before R is joining to the partnership, they can take half of the profit. That means they are sharing profits equally. Therefore, one is getting 150,000. But they are not recording this and they are recording after R's arrival. Then there are three partners. Then what is the amount each partner is getting? Only 100,000. And R is also getting 100,000. Therefore, this is not fair. What is the conclusion? The conclusion is, when the profit sharing ratio is changed, the adjustment should be made for the unrecorded assets in the books of accounts. So, what are the instances of recording these unrecorded assets? At the time of admission of a new partner, which we discussed earlier. At the time of a retirement, death, or designation of a partner. Any time where the partners are deciding to change the profit sharing ratio. Which means at any time the profit sharing ratio is going to change, unrecorded assets has to be recorded in order to eliminate the undue benefit that is getting by a particular partner. Right. Next, we'll move on to another concept, that is goodwill. We all know what goodwill is. Simply, that is the good name of the company, which has the ability to attract customers and which will in return result in increasing turnover, increasing net profits, and finally the net assets of the business. There are certain factors which are affecting to the goodwill of the business, goodwill of a particular business. What are they? The location of the business premises, where this is situated. Nature of the firm's products or the reputation of its service. Possession of favorable contracts. Complete or partial monopoly. The personal reputation of the partners. The possession of the efficient and contented employees. The possession of trademarks, patents, or a well-known business name, agency, or a franchise. The continuance of advertising campaigns. The maintenance of the quality of the product and continuous improvement and development of the product. So these are some of the ways how the goodwill is created. Goodwill is also need to be adjusted. This is one of the concepts that we discussed as which can be recorded as an unrecorded asset. So sometimes even though the goodwill exists, that may not be recorded in the books. Therefore, what happens? The partners' capital balances are understated to the extent of that share of capital. Therefore, these need to be recorded. How these are recorded? So as we discussed, according to the profit sharing ratio, this has to be recorded at the time of admitting a new partner, at the time of retirement, resignation, or death of a partner, and at any time where the profit sharing ratio is going to change. Right. What is the accounting entry for recording goodwill? The accounting entry is, now let's say, there is a goodwill amount and the new partner is not investing cash for the value of this goodwill. Therefore, the amount of the goodwill which they have unrecorded has to be recorded in the books. The total amount of unrecorded goodwill will be debited to a separate account called goodwill account, and that will be credited to the old partners' capital accounts. So the profit sharing ratio is the old profit sharing ratio, not the new one. Then that unfairness is eliminated because the goodwill which is created at the time of admitting a new partner is distributed only among the previous partners. Right. Here's a set of double entries. You can read it leisurely, but I will go through that and tell you what it is. This is charge of the goodwill from the new partner at the time of his admission. Now, let's say a new partner is coming into the business and he invests in cash to the business, and the amount that he invested includes this goodwill also. Right. Then he's, I'm sorry, to be clear, I will explain it again. The new partner will invest the cash in the business and it includes in the capital he brings to the partnership. That means there's no mentioning about the goodwill. He is bringing in cash and that includes his capital. Right. The total unrecorded goodwill will be recorded, debited to the goodwill account, credited to old partner's capital account, that we know. Then, for the new partner's capital account, that is debited according to the new profit sharing ratio and goodwill account is credited. So what is the net impact of this? Goodwill account is written off. Partners' capital accounts, old partners are credited to the old profit sharing ratio. New partners are debited to the new profit sharing ratio, which means the new partner, let's say there is only one new partner, the new partner's account is debited according to the new profit sharing ratio, and old partner's accounts are credited according to the which ratio? That is surrender profit sharing ratio. The difference between the old profit sharing ratio and new profit sharing ratio. If there is a capital account, and if this goodwill adjustment is made only through a capital account, then we'll forget about the goodwill account. Then old partners capital account credited according to old profit sharing ratio, and new partners capital accounts are debited according to new profit sharing ratio. So here, new partners will include all the partners, right? So if you take the net impact of this, then the new partners account will be debited and credited to the old partners according to the surrender profit sharing ratio. Right. Adjustment of new partners goodwill proportion. This is the one that I mentioned you, goodwill account debited, old partners capital account is credited. Then again, new partners capital account is debited and goodwill account credited. Old partners capital account is credited according to the surrender profit sharing ratio. New partner capital account, this is only one partner, the one who is coming now. New partner's capital account is debited according to the proportion only. That means, let's say, the business was sharing profits 2 to 3. And the new partner is coming for a profit share of 1/4. Then the new partner capital account is debited only by that 1/4 amount. Right? Okay. Adjustment of goodwill using a capital account, then again, according to the proportion, capital accounts are credited, and according to the surrender profit sharing ratio, old partners capital accounts are credited. Existing partners do not agree to raise an account for goodwill. Instead, they agree to open a loan account. So that means instead of creating an additional account for goodwill, what they do is they will pass this entry to a loan account. So simply, that is, other than creating a goodwill account, create a loan account. Loan account for the new partner debit, and existing partners capital accounts are credited. So credited according to the surrender profit sharing ratio, debited according to the new partner's goodwill proportion. That means only one partner, if as per the example I told you, only from the 1/4 of the amount. Right. If you want to understand what is surrender profit sharing ratio is, surrender profit sharing ratio is the sacrificing ratio, which is the difference between the old profit sharing ratio and the new profit sharing ratio. For example, let's say the business is originally having 2 partners and their profit sharing ratio is 2 to 1. And another new partner is coming into the business, then there are 3 partners and their profit sharing ratio is changed to 8 to 4 to 3. Now calculate the surrender profit sharing ratio. Write down the two ratios and then take a common base and take the difference between these two. Then you will get, for the new partner, 3 out of 15 will be added. That is his new partner's goodwill proportion. And the surrender profit sharing ratio will be for the 2 partners 2 to 1. Right. Now we'll see another area, that is when a partner is retired, resigned, or dead. Then, if a partner is resigned, retired, or dead, does that mean all the interests he had towards the partnership is going to cease? No. The partner is entitled to the repayment of the amount of capital due to him. Therefore, all the amounts that are due to him have to be paid. So, in order to get the value, the partnership business need to get the correct picture of the business. What is the correct value of net assets? Then revalue the assets and liabilities and get the correct value. Calculate the goodwill and take the correct value, and then it has to be distributed among the partners. So the balance, whatever is remaining in the current account, will be transferred to his capital account. Or it can be to a separate loan account. Whatever it is, this is the total amount that is entitled to the retired, resigned, or dead partners. If it is a dead partner, that will, deceased partner, that will be paid to an authorized representative. So anyway, this will be paid to that partner. So if this is paid at once, this is going to affect the business. So what happens is, the settlement can be done in two ways. One is, it can be treated as a loan to the firm, which means the total amount that is the current account balance is transferred to the capital account, and then taken the total amount, and that will be transferred to a loan account. And he will be paid an interest of 5% per annum. Right. The next one is, it is paid by way of an annuity. That means a certain amount during a certain period of time. That is paying by an annuity. Why this is done? In order to minimize the issues that are arising as a result of paying this whole amount at once. Right. Change of profit sharing ratio. If the profit sharing ratio is going to change due to any reason, then all the assets of the firm, including the goodwill, has to be revalued. Then only we identify the correct amount that has to be credited to the partner's account. Which means all the unrecorded profits and losses have to be recorded in the accounts and identify the true interest of the partners to the business. Okay, that's all about the presentation slides, and I have given you a few examples. Yes. We'll go through this question and see whether we have understood the concepts that we discussed so far. Read question number 1. Right, we'll see. A, B, and C are in a partnership sharing profits and losses equally. Following balances have been extracted after preparing trading and P&L statement for the year ended 31st March 2018. You are given certain balances which are extracted from the P&L statement. Right. It says capital account balances ABC, current account balances ABC, net profit for the year, that means the profit which is calculated from the P&L accounting profit, salaries for partners, this is also being um, considered in calculating the P&L, that's why it is coming here, salaries for partners, motor vehicle, that is a fixed asset, so that is a sunk cost, drawings, loan given by C. So these figures are recorded in the P&L as expenses, and some amounts are shown in the balance sheet. You are given some additional information. Following items, following terms are appeared in the partnership agreement. What are the terms? Interest on capital should be paid to partners at 10%. Right, there is a capital amount given, so interest on capital has to be paid at 10%. 5% interest should be charged against the drawings made by the partners. So if the partners have made any drawings, then 5% interest will be charged. All the partners are allowed salaries of 1,000 per month for the work done. So that is why it is being deducted from the expenses. Right. Following additional information is given. Partner C has given a loan on 30th June 2017. Partners have made their drawings on A at the beginning of the year, B at the end of the month of September. C will make it as 1st January, then it's easy to calculate. So C, 1st of January. A sales invoice of 15,000 has not been taken into books of accounts. Motor vehicle should be depreciated at the rate of 5% and has not been taken into books of accounts. Closing stock of the previous year has been overvalued by 5,000 and closing stock as at 31st March 2018 was underestimated by 9,000. Certain errors are there, certain calculations have not been performed. Other than that, there are certain terms according to the partnership agreement. What you're asked to do is to prepare the P&L appropriation account for the year ended 31st March 2018 and partners current accounts. Now what we have to do is, first we will draw the accounts. P&L appropriation account. Now for the time being, I will explain you, and then later on I will upload the answer to you. Right. You have to draw the P&L appropriation account, which is a T account consisting of 2 columns each side. Then the opening balance is the net profit for the year 180,000. That is the opening balance, which is coming as a credit entry to the P&L appropriation account. Then we are asked to prepare the current accounts, partners current accounts, another T account, separate columns for each partner. On the top of each column, you have to write the names of the partners. So A, B, and C. Opening balances, current account A, 10,000 credit, B, 5,000 debit, C, 8,000 credit. So these are the opening balances and the accounts we have drafted. Now we'll look into each and every item. So according to this calculation, you will see there are certain adjustments that we need to make. First one is, it says, it says a sales invoice of 15,000 has not been taken into books of accounts, which means the accounting profit that they have calculated here is not correct. Therefore, we'll do a working. Go to the workings and write down the net profit for the year is 180,000, and then sales 15,000 has not been taken into account. Therefore, it has to be added to the profit that have been already calculated. Then closing stock of the previous year has been overvalued by 5,000. If it is overvalued, that has to be deducted 5,000. And the closing stock as at 31st March 2018 was underestimated. If it is underestimated, it has to be added back. Right. Other than that, this one, motor vehicle should be depreciated at the rate of 5% and has not been done. Therefore, motor vehicle depreciation you have to calculate. The motor vehicle cost is 150,000. That into 5%. Calculate the figure, that comes to 7,500, and that expense have to be deducted from the profit. Other than that, are there anything that we need to consider? Yes, there is another thing, that is the salaries of the partners. Salaries of the partners have been paid out of the P&L, but these should go from P&L appropriation account. Therefore, we will add back the salaries of the partners, 2,000 and 8,000. We'll add back, and this is the working. We'll get the answer as the adjusted profit. Take the adjusted profit and record this value in the P&L appropriation account as the opening balance. Right. Then we will see interest on capital should be 10%. Interest on capital. Capital accounts are given ABC 20,000, 30,000, 10,000. So 10% of each. Interest on capital A 2,000, B 3,000, C 1,000. So these are debited to the P&L appropriation account. Total comes to 6,000. 5% interest should be charged against the drawings made by the partners. Drawings are given. What happens to the drawings? Do we record the drawings value in the P&L appropriation account? No. But we record the drawings value in the current account. So take the drawings value and debit to the current account. A 3,000, B 7,000, C 6,000. That is to the current account. And 5% interest should be charged against the drawings. Calculate the interest on drawings. But we have another adjustment. It says the dates of the drawings. A at the beginning of the year. So which means for the total year we can calculate the interest on drawings. Amount of drawings 3,000. Therefore, that into 5% comes to 150. That is the interest on drawings. How do we record the interest on drawings? Interest on drawings means current account debited and P&L appropriation account is credited by this amount. B, at the end of month of September, if it is the end of September, how many months are remaining? October, November, December, January, February, March, 6 months. So calculate 7,000 into 5% into 6 months. That comes to 175. So that is debited to current account and credited to P&L appropriation account. C, 1st January, C's interest is, C's drawings value is 6,000. So the amount of interest will be 6,000 into 5% into 3 months. So the value will be 75. That is debited to current account, credited to interest on drawings account. Sorry, credited to P&L appropriation account. Right. What are the other entries that we have to do? All the partners are allowed salaries of 1,000 per month for the work done. So maybe let's assume that they have calculated the salaries correctly. If you can remember, in workings, we adjusted this salaries 10,000. We added it back because that is a payment which is made to the partners. Therefore, in P&L appropriation, we have to deduct this amount. Deduct the salaries A 2,000, C 8,000, total comes to 10,000. So P&L appropriation account is debited, current account is credited by this amount. Right. A loan is given by C 100,000. If a loan is given, what happens? Then interest has to be paid. Interest is 5%. Calculate the loan interest 100,000 into 5% for how many months? 30th June 2017 to 31st March 2018. July, August, September, October, November, December, January, February, March. 9 months. So calculate the interest amount 100,000 into 5% into 9 months. That comes to 5,000. So this 5,000 is an expense which is incurred in the normal course of business. Therefore, before we take the profit for P&L appropriation, that has to be adjusted. You have to make another adjustment in your workings. Go to workings. Now, you have done certain adjustments to 180,000. Deduct this amount as well. Interest on loan, 5,000 also have to be deducted. Then you will get another figure, not the one you calculated earlier. The correct one, you take it as the opening balance in P&L appropriation account. Then this is a loan. Therefore, we know, like in any other business, this partnership business is having a loan account and they are having a credit balance of 100,000 in the loan account. This interest charge is also credited to the loan account. Why this is credited to the loan account? At the time of terminating the business, at the time of dissolving the partnership, then these loans are being paid prior to the current account balances. Therefore, this is recorded in the loan account separately. So 5,000 will be credited to loan account, debited to the P&L account, not to P&L appropriation account, to the P&L account. Now, that's all, the entries are done. Now what you have to do is you have to calculate the balances. Calculate the P&L appropriation account, balance it, take the balancing figure, that is the share of profit that has to be distributed among the partners. The profits and losses are shared equally. Therefore, whatever balance you are getting will be divided by 3 and each partner is getting that share. So the same amount will be recorded in the current account as well. Current account credited, P&L appropriation account debited. Right. That's all, the first question. We'll move on to example number 2. Read the question. Right, we'll see. A and B are the partners carrying a partnership business sharing profits and losses at the ratio of 2 to 1. On 1/1/2012, C admitted as a partner for a 1/5 of share of profit, and goodwill was valued at 90,000 on that date. C agreed to bring 200,000 as his capital. Although all this information are given, what you're required to do is to calculate the new profit and loss ratio, the new profit sharing ratio. There are 4 scenarios given. First scenario, 1/5 share of profit was given by A and B equally. Second scenario is 1/5 was given by A and B according to the current profit sharing ratio. 3, 1/5 was given by A and B at the ratio of 3 to 2. Fourth scenario is 1/5 was given by A, completely given by A. Now you have to calculate the new profit and loss sharing ratio according to the 4 scenarios given. Right, we'll see the first one. 2 partners, A and B, profit sharing ratio is 2 to 1. New partner is coming C. His profit share is 1/5. According to first scenario, it says 1/5 share of profit is given by the partners equally. So 1/5 divided by 2, that means each partner is giving 1/10 of profit out of their profit share. So 2 to 1 means A is getting 2 out of 3, B is getting 1 out of 3. So in order to calculate A's new profit share, we have to deduct 1/10 from 2/3 profit share. For B, we have to deduct 1/10 from 1/3 of his profit share. So you know how to deduct fractions, that is maths. So you deduct the fractions and then you will get A is getting 19 out of 30, B is getting 9 out of 30, and C we know he is getting 1 out of 5. So all these figures have 30. We'll convert this 1 out of 5th also into 30. So that will be 6 out of 30. So the new profit sharing ratio will be 19 to 9 to 6. That is the new profit sharing ratio according to the first scenario. Second scenario, it says 1/5 was given by A and B according to the current profit sharing ratio. Current profit sharing ratio is 2:1. Out of the current profit share, out of the total profits they are earning, they are giving 1/5 according to the current profit sharing ratio. So if we forget about this 1/5, how much is remaining? Remaining is 4 out of 5. 4/5 is remaining. So we will calculate now how much will be borne, what is the profit sharing ratio of A and B. A's profit share will be 2/3 out of 4/5. B's profit sharing ratio will be 1/3 out of 4/5. C is anyway getting 1/5. That is his profit share. So when you deduct these figures, you will get 8:4:3 as the new profit sharing ratio. Third one, 1/5 was given by A and B at the ratio of 3:2. Another ratio is given to you apart from the existing profit sharing ratio. Another ratio is given to you to share the profit of C. How this is calculated? Now we have to see what is 3:2 means 3 out of 5 and 2 out of 5. For A, it will be 3 out of 5. So we will calculate what is the amount or the fraction we are getting when we calculate 1/5 into 3/5. Then we will get 3/25. That is the ratio that is coming to A. For B, that will be 1/5 into 2/5. That is 2 out of 25, which is coming for B. So then what you have to do is, this is how they are sharing the profits, sharing the new profit share of C. Once you calculate these figures, now you have to deduct this calculated amount from the original profit share. Original profit share is 2:1, which means A is taking 2 out of 3, B is taking 1 out of 3. So what is the amount, what is the profit share A is getting? 2 out of 3 minus 3 out of 25, which we have calculated. For B, it will be 1 out of 3 minus 2 out of 25. Then you will get the new profit sharing ratio as 41:19:15. Last one, we will move on to scenario 4, that is 1/5 was given by A. That means the total amount is borne by A. So A's existing ratio is 2 out of 3. B is 1 out of 3. So we'll calculate A's ratio by deducting 1/5 from the existing profit ratio of him. So 2/3 minus 1/5. Then you will get 7 out of 15. For B, that is the existing profit sharing ratio because he is not going to bear any costs. Therefore, his profit sharing will be 1 out of 3. If we convert it into 15, that will be 5 out of 15. And for C, that is 1/5. Therefore, out of 15, that will be 3. So the new profit sharing ratio is 7:5:3. So this is how we calculate the new profit sharing ratios. Right. That's all I have to discuss under accounting for partnerships. And maybe we will be discussing more questions during the tutorial sessions. And also, I will be uploading the answers for these questions in LMS soon. Thank you very much.